But where are we headed in the medium term? What do we buy? Is this rally already too hot for us? For all those questions, Hiren Ved, the CEO, Director and CIO at Alchemy Capital Management, joins us now. Hiren, good morning. Thank you very much for joining us on what's a very important week, festive week for us. So festive greetings to you and your family as well. Have a great Samvat 2079. But tell us what the market can do. Are new highs just round the corner, or are we already a bit too hot to handle?
Well, Lata, to begin with, a happy Diwali and a happy New Year to you and everybody at CNBC TV18 and all the viewers as well. Well, Lata, I mean, I have no doubt that, we are very close to new highs and you could hit new highs, sometime soon. I think Indian earnings have been reasonably good. And I think India is on a fairly good wicket, both when it comes to macro and micro. And as I've always been saying, the Indian market is behaving like a strong stock. It corrects less when global markets correct. And at the first signs of stability, we kind of take off. And I don't see that changing dramatically, unless obviously, for whatever reason, if oil prices go up, that's something that we need to worry about. But that doesn't seem to be a worry at this point in time as well. So I think we are on a fairly good wicket and we continue to be very, very positive on the Indian markets.
Okay, very positive on the Indian markets here.
And new highs around the corner.
Yeah, I think that statement has been echoed by a lot of our experts who've come in, right, through the course of Diwali. Hiren, greetings of the season to you. I want your thoughts on PSU Banks, because anyone and everyone is now starting to get positive, and we have a lot of bullish commentary coming in from the largest bank, SBI, just a while back. Do you only stick with SBI or do you move outside? Because many of these banks have had a great trading rally in the last couple of months. But is it just that, a trading rally, or should investors look here as well?
So I think, Sonia, the entire banking space has done phenomenally well. And to be fair, I think the public sector banks have led from the front, because their balance sheets were never this clean. And this time, everybody's starting on the same starting line. So whether it's the public sector banks or the private sector banks. And there was also a valuation cushion as far as public sector banks were concerned. And therefore, I think in this market, where it's tough to find value, where earnings are growing, clearly public sector banks is one area where there was both value and growth. And therefore, we are seeing the kind of performance that we are seeing in the public sector banks, right? Also, I think given where we are, if there is one read-through from all the financials results that we've seen so far, obviously credit costs have been very benign, credit growth has picked up, but I think soon in a quarter or two, there will be a fight for deposits. And that, to my mind, is likely to put some pressure on NIMs going forward. Not that the banks can't handle it, but in my view, we are, maybe another quarter of good NIMs, and then I think NIMs will peak out as deposit rate starts to go up. Most of the banks are running very tight loan-to-deposit ratios, and that's where the public sector banks have a little bit of an edge because they typically tend to have great deposit franchises, right? And that's being reflected in the current valuation. So I think while banking continues to be a great sector to remain invested in, but I think investors just have to be careful that some banks will see a contraction in NIMs going forward as the fight for deposits starts.
Okay. Hiren, sorry, go ahead.
Yeah, morning, Hiren. Wanted to ask you about the other big sector. That's the IT space. Been a big underperformer this year. However, in the last month or so, there has been select buying that we've seen in a couple of these names. What's your view on the space at this point of time? Because the global environment is still in a tizzy. Would you start chipping in there or would you still stay away?
I think tech sector has always been a great sector for investors. What happened was that the fears of a recession in the US got priced in very quickly in the tech sector this year. And we already seen a significant correction in most of the IT services companies, especially the large caps, right? And while there could still be client level issues, given what we are seeing in the US, and some of the big mega tech companies in the US have not shown very great results. They are cutting back on spending, and many of their revenue streams are also discretionary, right? So you will see that companies there are cutting on ad spending on YouTube and Instagram and stuff like that. So while there might be a few sectors or company level client issues, but on the whole, I think that the worst has been priced into the tech sector. And I think in a couple of quarters, you will start to see tech starting to perform again. Also, mind you that there is, the supply side issues in tech are getting now slowly resolved as manpower pressures go away. And you also have the tailwind of currency, which will also come in and help the margins next year. So even this year, this quarter itself, if you see, quite a few companies have shown reasonably good margins, even as top line has slowed. But none of them are complaining in terms of either order values or order books or pipelines. So I think the tech sector is fine. It went through a soft patch, which was to be expected from a high base. But I think now, there is value emerging in tech as well.
Okay, point taken. But if I want to develop the point that Nigel started off with. Meta and even Alphabet warned that they will not hire, but actually lay off. We could expect slower hiring in India as well. Now, what are the avoid sectors, therefore? Because of lower hiring or recession in our export destination countries, like say Europe or in the Western Hemisphere, are there avoid sectors?
So I think it's difficult to get one-to-one correlation between what's happening in the US and where it could impact Indian companies. As I said, that there could be a one-off impact in a few clients or a few client segments for exporters from India. But I don't think that it is because of what's happening in the US, tech or any other sector should be avoided. And Lata, if you look at the trend of the last couple of years, whenever there has been a slowdown in the US, after the first few quarters, Indian companies have actually increased their market share, because as US companies start to cut costs, they tend to outsource more. And that's usually to the benefit of Indian IT services companies, right? So I don't think that it's such a bad news. US is getting what they wanted. They are tightening, they're raising rates, and they want the economy to slow down to bring inflation down. And that's exactly...
Hiren, 1 minute. I'm not talking about the IT sector. What I'm saying is that because of global slowdown or Western Hemisphere slowdown, even Africa is in trouble. We could have an export slowdown. In fact, it's already showing in the numbers our exports are plateauing. Can there be, lower demand for certain things? We do already have a bit of a rural slowdown in India. Like staples. Can there be sectors like that which could get affected because of, multiplier effect of some kind of slowdown globally?
Absolutely. I mean, it's quite possible. We're seeing that in the two-wheeler exports also, right, Lata? I mean, in the sense that if you look at the numbers from Bajaj or TVS, we are seeing a slowdown because some of the African markets have had problems with Forex and slowing down of demand there. So I think that where sectors have a significant exports, there will be some impact for sure. How long will it last? It's a guess. But I think for the time being, I think Indian demand-facing sectors are likely to do phenomenally well. You could see some softness, whether in autos or companies which are supplying into some of these end markets might see a slowdown in exports. That's very much possible.
Okay. Well, the market is still holding. Nifty is still up over 100 points, but it's not building on to its gains in any way. The bank Nifty also, after 300-point bump up, has just stabilized around the 280, 290 points higher. Hiren, there are so many spaces that have come out of the woodworks, you know, this year, whether it's something like defense, renewable energy, or electric vehicle plays. In defense particularly, I mean, even as we speak, something like a Bharat Dynamics is surging. Is there still more scope here?
So yes, Sonia, I think what's happening is that finally, what we've been expecting for many, many years, that defense manufacturing will take off in India, is beginning to happen. And what happens in the early stages of the cycle is that even before earnings start to go up, the PE multiples of this sector tend to expand. And that's what the market is discounting, that they're discounting that over the next few years, these companies will see bulging order books, because more and more stuff is going to be manufactured in India. There is a very, very clear policy shift that is happening, where the government is very clear that they want more defense to be manufactured in India, not just for India as well. In some areas, we are even looking at exports, and we've started to see that. So I think the market's re-rating the sector. And what you're seeing is a PE multiple expansion in the defense sector across the board. And we will see a follow through in terms of earnings growth as well. We are already seeing that when you look at the order books of many of these companies. And that's what is getting reflected, in my view.
Okay. Well, we'll have to leave it at that. It was a pleasure speaking with you, Hiren, and thank you for ushering the Samvat 2079 conversation by saying that new highs are round the corner. Have a great Samvat yourself.